Teradyne just delivered a massive earnings beat. I mean, they completely blew past the high end of their own Q2 2026 guidance. We are looking at a revenue print of $1.329 billion.
Yeah, which is just wild because that is up 104% year over year compared to Q2 2025's $652 million.
Exactly. And their non-GAAP earnings per share, which, strips out all the one-time accounting noise so you can see the actual operational profit, that hit $2.47.
Right, a 333% explosion from 57 cents last year. It's just massive.
And the momentum doesn't seem to be slowing down at all. Looking ahead, Q3 2026 guidance projects revenue between $1.2 and $1.3 billion, with non-GAAP EPS sitting between $1.85 and $2.15.
So the mission for this deep dive is to figure out the actual mechanics behind those staggering numbers. We're going to walk you through the segment performance, the margin profile, and how management is allocating all this new capital.
Right, and from there, we really need to parse the management commentary on AI data centers to understand the physical reality of what's driving this top-line explosion.
Definitely. And finally, we'll outline the very notable risks, specifically the macroeconomic and geopolitical threats that are sitting out there and could completely derail this growth story for you.
So let's start by breaking down that $1.329 billion top-line number, because the revenue stack here tells a very specific story about where the capital is flowing right now.
It really does.
Semiconductor test is the absolute juggernaut of the quarter. It brought in $1.122 billion, representing 84% of their total sales. That alone is a 128% year-over-year increase.
Yeah, and then way down the stack, you have product test bringing in $107 million, which is 8% of sales, and up 26% year-over-year.
Right.
And finally, the robotics segment sits at $100 million, also 8% of sales, and growing 33% year-over-year.
When you look at this revenue stack, semiconductor test isn't just the engine. I mean, it's the entire rocket ship, while robotics and product test are essentially just the fins.
That's a great way to put it.
And the breakdown between product and service is equally critical for you to grasp here. This was an overwhelmingly hardware-heavy beat. Product revenue accounted for $1.191 billion of the total, while service revenue remained basically flat at $138 million.
Yeah, it was practically a rounding error compared to the hardware sales.
So I have to pause on that product versus service mix. In modern tech investing, everyone is obsessed with recurring revenue, right? The whole software as a service model where you sell something once and collect a subscription fee forever.
Right, the holy grail of tech margins.
Exactly. But Teradyne just printed over $1 billion in pure product sales with flat service revenue. Does a 128% jump in one single hardware segment indicate a sustainable business model, or are they dangerously top-heavy right now?
Well, look. It looks lopsided on a spreadsheet, but you have to understand the physical mechanics of the semiconductor testing industry. It's not SaaS. Teradyne isn't selling a cloud subscription.
Right, they're building actual physical machines.
Exactly. They sell automated test equipment, or ADE. These are massive, incredibly complex physical machines that get installed directly onto a semiconductor factory floor.
So when a chip manufacturer buys ADE, they are making a massive upfront capital expenditure just to build out their production line.
Precisely. So that $1.191 billion in product revenue is the literal sound of tangible, heavy machinery being shipped and bolted down. While it is top-heavy, the sheer volume of the semiconductor segment is what allows them to hit these record numbers.
So the flat service revenue isn't a failure of their sales team. It's just the natural physics of how hardware gets deployed. You have to sell and install the giant machine before you can ever hope to service it.
That is the crucial takeaway for anyone listening. In the semi-equipment space, the product installation cycle always dictates the initial revenue burst.
Makes sense.
The top-heavy nature you're pointing out is a feature of the current stage of the global capital expenditure cycle. The fabs are buying the hardware right now. Service revenue will naturally trail that installation base in the coming years.
Which pulls us directly into management's commentary and the overall wafer fab equipment, or WFE, market. Because CEO Greg Smith was very deliberate with his phrasing here.
Yeah, he really was.
He stated their strategy is capturing test and robotics opportunities, quote, from wafer to AI data center. And whatever they're doing, it is translating to the bottom line, because management noted this was their second consecutive quarter of record revenue.
And a massive underlying driver for those consecutive records was what management called record memory revenue. We are seeing continued, sustained strength in DRAM memory, paired with a very sudden, aggressive resurgence in NAND final test.
Okay, I need to play devil's advocate here on behalf of the listener. Every single tech company on Earth is desperately trying to brand themselves as an AI play right now to juice their valuation.
Oh, totally. If they use a spreadsheet, they call it AI.
Right. So looking at the second half of 2026, management expects it to represent 48% to 50% of full-year revenue, citing a broad-based strengthening beyond compute. Based on their WFE projections, which they see hitting 250 billion as early as 2028 or as late as 2030, is Teradyne actually a fundamental AI infrastructure play?
Or are they just riding the coattails?
Exactly. Are they just a legacy hardware company catching a lucky wave in the current CapEx cycle?
The physical data proves they are the literal toll booth for global AI deployment. Let's break down the mechanics of why that is.
Please do.
When the public thinks about AI infrastructure, they immediately picture the graphic processing units, right? The massive AI chips themselves from the big designers.
The $40,000 chips.
Exactly. But before one of those highly advanced chips can be slotted into a data center rack, it has to be rigorously tested. The complexity of modern AI silicon is staggering. We're talking about billions of transistors stacked in three-dimensional packaging.
So if one microscopic connection fails,
The entire piece of hardware is useless.
yes.
And Teradyne operates across the entire spectrum of catching those failures. They specifically highlight system-level test, or SLT, as well as high-speed interconnect test and traditional ATE for systems on a chip in memory.
Okay, but what does that testing actually look like in practice? Because that's a lot of jargon for someone just trying to understand the business model.
Let's use an analogy. Imagine a manufacturer building a brand new, highly complex race car engine. Traditional automated testing is like checking if the spark plugs spark and the pistons move while the engine is just sitting on a workbench.
Necessary, but it doesn't tell you if the car will actually win a race.
Exactly. System-level test, or SLT, is like taking that engine, dropping it into the chassis, putting the car on a dynamometer, and simulating a 200-mile-per-hour race in 100-degree heat.
Oh, wow.
Yeah. Teradyne's SLT equipment mimics the exact real-world environment, and software loads the AI chip will face when it is finally installed in a hyperscale data center.
Oh, that makes perfect sense. They aren't just checking if the silicon conducts electricity. They are forcing the chip to run the equivalent of a heavy AI workload while it is still on the factory floor just to see if it breaks.
And it goes deeper than just the main processor. You brought up high-speed interconnect test. AI data centers don't just use one chip, they string tens of thousands of chips together
Right, they all have to talk to each other.
at light speed.
Yeah.
If the interconnects are flawed, the whole system bottlenecks. Teradyne tests those high-speed pathways, and then you have the memory, the DRAM and NAND resurgence management highlighted. High bandwidth memory is bolted directly next to the AI processors so they can feed massive data sets into the compute engines instantly. Teradyne tests that memory too.
So when the CEO says they are capturing opportunities from wafer to AI data center, he is being quite literal.
Very literal.
They are probing the raw silicon wafers, they are testing the memory that sits next to the chip, and they are stress testing the final assembled package before it ever goes into a server rack.
Right. If you're a global semiconductor manufacturer building the next generation of AI compute, you physically cannot ship your products without passing them through this kind of testing equipment.
It's unavoidable.
Completely. The wafer fab equipment market expanding to 250 billion means the sheer physical volume of advanced silicon being manufactured is going to skyrocket over the next few years. More complex silicon means exponentially more testing.
So they aren't just riding a trend, their hardware is the mandatory physical checkpoint for the entire AI capital expenditure cycle.
Exactly.
Well, the narrative of the massive revenue beat makes complete sense now. The AI boom requires more chips require more testing, and Teradyne builds the testing machines.
Simple as that.
But let's transition from top-line growth to operational efficiency, because printing $1 billion in revenue doesn't mean much to an investor if it costs $1.5 billion to generate it, right?
Right. You have to look at the bottom line.
And the financial metrics here are staggering. Gross margin expanded to 59.8%, which is up from 57.3% in Q2 of 2025. Their operating expenses, the OPEX, sat at 26.1%, which comes out to roughly $346 million.
Which led to a massive operating profit of 33.7%, or $448 million.
And the cash flow metrics are just as vital for us to dissect. Free cash flow massively accelerated to $378 million, up from $132 million year over year. Meanwhile, their days sales outstanding, or DSO, held remarkably steady at 76 days.
Let's stop at day sales outstanding for a second, because that is a metric that often glazes people over.
Totally.
For a company shipping multi-million-dollar, custom-built heavy machinery across the globe, getting paid in under 80 days seems incredibly efficient.
Oh, it proves that their customers are highly liquid and desperate for the equipment. They aren't fighting to collect their invoices, and that rapid cash collection allows them to aggressively return capital to shareholders.
Right.
In the second quarter alone, they returned cash via $69 million in stock buybacks and $20 million in dividends. Note the historical perspective here, because since 2015, Teradyne has repurchased 87 million shares at an average price of roughly $55 per share.
Wow.
Yeah, that totals $4.792 billion in buybacks over the last decade.
That's a massive capital return.
It is. But I want to dig into those margin numbers for a minute, because for a retail investor parsing this, the math looks almost contradictory. It is incredibly rare to see a company double its revenue while simultaneously expanding its gross margin by 250 basis points.
Usually that kind of scaling comes with immense growing pains.
Exactly.
Mm-hmm.
Usually they have to pay massive overtime, expedite shipping for raw materials, or hire thousands of new staff, which balloons their operating expenses and crushes their margins. How did they double revenue without their costs spiraling out of control?
You're identifying the concept of operating leverage, and this quarter is a masterclass in how it works mechanically.
Okay, walk me through it.
When a company enters a hypergrowth phase, the biggest risk is growing broke. The top line looks amazing, but the bottom line bleeds out because they are frantically trying to build new facilities and hire staff just to keep up with the order book.
Right, bloated OpEx.
But Teradyne managed to keep their operating expenses constrained to the mid-20s as a percentage of revenue, 26.1% to be exact, while pushing twice the volume of sales out the door.
How does that actually work on the factory floor, though? I mean, if you are building twice as many machines, shouldn't it cost twice as much to run the business?
It costs more in raw materials, certainly, but your fixed costs do not double. Think about the basic mechanics of a manufacturing business. You have research and development teams, administrative staff, and factory overhead. Those are largely fixed costs.
So the rent is the same whether you build one machine or 10.
Exactly. If you're producing 100 machines a month, those fixed costs are spread across 100 units. If the AI boom hits and you suddenly start producing 200 machines a month using the same facilities and the same core engineering teams, those fixed costs are now spread across twice as much revenue.
I see. Every additional machine they sell beyond their break-even point is incredibly profitable because the rent and the engineering salaries are already paid for.
That is the essence of massive operating leverage. That 250 basis point expansion in gross margin tells you that their manufacturing and supply chain processes are highly optimized.
They didn't have to panic.
Right, they didn't have to pay desperate last-minute premiums to secure parts. They held their fixed costs steady, pumped twice as much revenue through the system, and allowed every marginal dollar to generate significantly higher profit.
That discipline is exactly why that $378 million in free cash flow was able to bypass the expense column and drop straight onto the balance sheet.
Which gives them the literal cash ammunition to execute those massive share buybacks you mentioned. Returning over $4.7 billion in buybacks since 2015 isn't a reaction to a single good quarter.
No, it's a deliberate strategy.
Exactly. It shows a very deliberate long-term strategy to utilize the massive cash generation of these cyclical semiconductor spikes to permanently reduce the share float.
It creates a compounding effect for the investor. If the company is generating more total profit and there are fewer total shares in existence because management keeps retiring them, the earnings per share for the remaining stockholders naturally accelerates.
Right. So with the financial engine clearly firing on all cylinders, what does this mean for their forward-looking projections?
Well, management laid out a target earnings model for 2025. They are projecting the AE total addressable market to reach somewhere between $12 billion and $14 billion globally. For Teradyne specifically, they are targeting roughly $6.0 billion in annual revenue.
Okay.
They're aiming for a gross margin between 59% and 61% and a non-GAAP EPS in the range of $9.50 to $11.
Those are incredibly ambitious targets. But we need to pivot to the macroeconomic realities that could threaten it, because this raises a vital point for you to consider as you evaluate this space.
It's definitely not a risk-free environment.
Far from it. The earnings report explicitly highlights the safe harbor risks, and they are substantial. You have the threat of macroeconomic downturns, which could cause those massive data center customers to immediately freeze their capital expenditures.
Right.
You also have the risk of delayed product demand. And given the physical nature of what they build, the ever-present threat of supply chain shortages.
But we absolutely have to talk about the geopolitical risks here. The earnings release places a very heavy specific emphasis on U.S. Department of Commerce export control regulations. They explicitly call out tariffs and restrictions regarding China, Huawei, Silicon, and military end users.
Yeah, that's a huge one.
They also noted the Israel-Hamas conflict as a stated geopolitical risk. When you look at their 2025 target model aiming for roughly $6 billion in annual revenue, and you overlay these intense U.S. and China export controls on semiconductor equipment, how vulnerable is this roadmap to geopolitical whiplash?
I mean, it is incredibly vulnerable.
Yeah.
And to understand why, you have to look at the physical reality of the product again. Teradyne is not selling a consumer software app.
Right.
If a software company faces a regulatory ban in one country, they can instantly pivot their marketing spend to Europe or South America with the click of a button. Teradyne is building massive, multi-million-dollar physical testing suites. Once that machine is built, it has to be put on a cargo ship and delivered to a specific factory.
And the U.S. government has very strict opinions on where those cargo ships are allowed to go.
Very strict. The U.S. Department of Commerce export controls are specifically designed to restrict advanced semiconductor manufacturing equipment from reaching certain end uses in China.
So the goal is to prevent cutting-edge silicon technology from empowering military applications or restricted entities like Huawei and Silicon.
Exactly. And because Teradyne's equipment is the mandatory toll booth we discussed, the machine that proves the highly advanced silicon actually functions, any sudden regulatory change creates an immediate physical bottleneck for their hardware delivery.
Regardless of how high global demand is.
Exactly.
So Teradyne could have a Chinese fab customer begging for a machine, willing to pay top dollar, and Teradyne could have the machine fully built and sitting on a loading dock. But if the Department of Commerce denies the export license, that sale is dead in the water.
The revenue evaporates instantly. It simply does not matter how high global demand is. If the geopolitical lines drawn on the map prohibit the sale of advanced semiconductor equipment to a specific region, Teradyne just cannot service that portion of the total addressable market.
That paints a really stark picture of the limitations here. Even with a projected $250 billion wafer fab equipment market globally, geopolitical tensions could actively block companies like Teradyne from participating in massive regional deployments.
The roadmap to $6 billion in revenue relies heavily on relatively stable international trade relations. A sudden escalation in tariffs, a broadening of the restricted entities list by the U.S. government, or disruptions from regional conflicts forces companies to halt shipments and scramble to reroute their global supply chains.
It's the ultimate exogenous shock.
It really is. It is completely outside of management's control, yet it has the power to instantly rewrite their target earnings model and trap millions of dollars of inventory in warehouses.
So we have covered a massive amount of ground in this deep dive today. We've unpacked the 104% top-line explosion and seen how heavily weighted it is toward the semiconductor test segment. We've broken down the mechanics of system-level test, proving that the AI data center boom literally forces the entire industry through Teradyne's physical testing toll booth. We've mapped out the operational leverage that allowed them to expand margins and drop hundreds of millions in free cash flow straight to the bottom line for share buybacks.
And finally, we looked at the very real geopolitical ceiling that could complicate their path to that 2025 target model.
Right.
It is a textbook high-reward, high-complexity setup. The financial execution this quarter was pristine, and their positioning within the AI supply chain is undeniable. But, the macroeconomic and regulatory environment surrounding semiconductor equipment requires constant, vigilant monitoring from anyone tracking this space.
Which leaves you with a final, lingering question to consider based on the data we've walked through today. Teradyne's current explosive growth is almost entirely tethered to the AI compute and memory cycle.
Absolute.
We know the wafer fab equipment market is projected to reach its peak of around $250 billion sometime between 2028 and 2030. But what happens when that market finally begins to plateau?
That's the big unknown.
Will their much smaller robotics segment, which is currently growing at a very respectable 33%, will that be mature enough by then to step up and carry the company's valuation? Or is Teradyne destined to remain purely a cyclical semiconductor proxy, endlessly riding the boom and bust waves of global chip manufacturing?
It's definitely something you have to keep in mind as we watch this play out over the next few years.
Make sure you follow the show for our daily no-nonsense earnings coverage.